I think people will always underestimate, they'll underestimate or make assumptions based off, if you're different from what they expect, right? I do think that it's more about not being afraid to speak up. Said other funds start at a time of plenty. We came at a time of
literally.
You started saving at a time when you didn't
have a surplus.
You didn't have a surplus, and in fact, you were having a reduction in budget. And I think that's part of what is unique about our leadership, and then also about the founding of the fund. The priorities for us are, first of all, to say within the portfolio that we already have, for instance, the companies that we own, how much more, how can you support them to grow faster? Some of them are much younger, so it's a factor of time. Others, it's when they need more capital, what are they investing in, and so on.
Hello there. My guest this week on the Long Form podcast is Tesi Rusagara, the CEO of the Agaciro Development Fund. The Agaciro Fund is Rwanda's sovereign wealth fund. We shall discuss this week her journey, the fund itself, and why it's so important for Rwanda's development journey. Hello there. Before we dive into today's conversation, have you subscribed to our channel yet? If you haven't, do so. And remember to share your thoughts with us in the comments below and like this video. Your support means a lot. Now let's get into it. Ms. Rusagara.
Hi, Sanny.
Welcome to the Long Form.
Thank you, Sanny. Thanks for having me. I'm a big fan, so it's a pleasure to be here.
Yeah, I'm a big fan of you personally. We're friends, and I'm a big fan of Agaciro Fund. So this is a big deal for me to have the CEO in that chair.
Thank you. Thanks for having me.
Yeah. So at less than 40 years of age, I kind of went through your LinkedIn, and I literally had to go into the next page. You know how you have, job description, and then they're like, oh, but there's another side to it as well. 40 years of age, actually you're below 40, obviously, unlike myself. You've done so much in that period of time. Like it's actually quite impressive. You've been senior consultant at Deloitte. You've worked as an investor relations officer, Bank of Kigali. Worked in the office of the president. Been a venture fellow at Mustard Seed Impact. Are presently a board member at the Capital Markets Authority. Had been the MD of Kigali Innovation City, and now CEO of Agaciro Fund. How have you managed to cram so much in such little time?
Thanks, Sanny. How does one answer this? I think my background is in finance, so academically, I studied finance in undergrad. And
where?
At the University of Cape Town. And then later I did an MBA. And so
where?
And later I did an MBA at Stanford University. And so I think those academically I've been in the business finance space. And then from a career perspective, I started my career in Bank of Kigali, actually working on the IPO, the initial public offer to the public, which was the second listing on the Rwanda Stock Exchange at the time. And it was the first time we'd launched a stock exchange that year. And within 6 months, we had first Barirwa and then Bank of Kigali. So it was a very exciting time to be in finance in Rwanda. And I think it also set a trajectory in terms of what I was interested in, because at the time we were raising money. So it was both looking at foreign investors, local investors. When the IPO was done, there's a lot of promises that the bank had made in terms of what it would use that extra financing for, which was to grow the branches, to invest in technology, to do bigger size loans for the private sector, and to also grow the retail market. And so it allowed me to work on many things. There was policy, there was regulation, there was finance, there was business development. And I think all these just, I like to do multiple things, and I like to be challenged. So it gave me an opportunity to work on very different aspects of the transaction, but also within the bank, to just touch on multiple fronts. And then later on, that then made me interested in strategy and policy, and which is how I ended up in the government, because a lot of the vision for what the bank was doing at the time was really coming from a policy perspective. The government had said, we want to grow our capital markets and our stock exchange, which led to the IPO. There was also a need to grow electronic payments, which was one of the big strategies that the bank had taken on at the time, and that's what they were raising money for. So there was really this need to understand what's the big picture, what's the story, what's the vision. And then I had the privilege to work in the Office of the President in the Strategy and Policy Unit, and to at least see that up front and participate in sort of shaping and following up on that. And so I think over time, what my interests have really been at the intersection of finance, of policy, technology as well, because over time, just realizing that that is where the future is going, and having the opportunity to be in Silicon Valley and to both study and work there, gave me a front row seat to see what types of investments do we need to be looking at as a country? Where's the world going? How is technology shaping our sectors and our industries? And I'm not a traditional techie. I'm not an engineer. But I think understanding technology from a business and policy side is important for all of us. And so over time, I think my career has almost been like a mismatch of very different sectors, but I think very connected sectors that help, that have sort of mashed up together. So eventually that led to interest in venture capital, in technology strategy, I worked a lot on digital transformation projects when I was in consulting for financial services. So all that has sort of led me to where I am today, which is also relevant for the fund, because, and I think we'll get to that, but these are some of the questions that you're grappling with in terms of the sectors you're invested in. How are they dealing with innovation and technology? Or you're looking at strategy, or you're looking at regulation and how that affects business. So over time, I think it's been an interesting path, but somehow that they've all been very connected, even though I didn't always see the connections along the way. I just sort of followed what is interesting at this point and what do I think I need to learn more of to be better in whatever role I was in at the time.
Very many people, when they get the chance to get to those spaces, and in this case, I'm talking about Silicon Valley, Stanford, that kind of, they stay there, right? The opportunities, there's money, a lot of money to be made. It's where a lot of things are happening. It must be very vibrant. Why did you choose to come back?
Well, I went when I knew I always wanted to come back. So I think that helps. I had the end in mind. But at the same time, I recognized that I wanted to also understand what that world looks like. What are the opportunities? What does working in a very mature market like the US look like? What kind of problems are they grappling with, and so on? So I think I definitely wanted to at least experience that, both academically but also professionally. But at the same time, it was with the view of how is that then relevant for Africa? How is that relevant for Rwanda? And I think one of the privileges we have as a country is that we have very big ambition, a very big vision. It's a place that wants to attract talent, not just Rwandan talent, but even foreign talent, and to bring you back home. So I think when I looked at, there's a very big diaspora community in the US, even in Silicon Valley, but not everyone has that they don't always have that back home. You find a lot of people are also maybe escaping because the opportunities are not as attractive at home, or you don't have the opportunity to participate. And I think that's a privilege that we have here, where you actually have the opportunity to participate, to bring your skills it's required, and to have an impact. And I really wanted to see what would it take to how do you leverage all that knowledge, all that network and skills that you've built, and then apply to a context that is important for you and that's relevant for you. And for me, that was doing it here at home in Rwanda.
Yeah. So today, young lady like yourself, below 40.
I'm older than most Rwandans. The median age is 19.
Well, would you still be called a youth? Are you still defined as a youth?
I don't know statistically if we're still youth.
So, but still very young.
Yes.
Woman, obviously. When you walk into rooms with other CEOs of other sovereign wealth funds, aren't you probably the youngest person there? And I'm not even talking about whether or not there's other women in that room, but I'm just saying, just in age, do you actually go and find younger people than you?
Well, when you walk into the room in Rwanda,
no, sovereign wealth
unique.
funds. Yes.
When you walk into the room with other sovereign wealth funds, not necessarily. I think this is finance in general, and then even this sovereign wealth fund specifically is still very much male dominated. And yeah, you'll find that people have gray hairs. So no, I mean you will stand out. Yeah, it's
Is there a lot of women in that space?
Not as CEOs. I think in the C-suite you start to see it. Not so much, but this, like in general in the finance industry, I think there's still a big representation issue when it comes to females, especially in the senior levels.
What's that experience like, though? Do they listen to you, or are they looking at you and saying that this young lady over here, there's not much to hear from her?
I would say it's about how I think people will always underestimate. They'll underestimate or make assumptions based off, if you're different from what they expect, right? And so this is something that happens a lot, but I do think that it's more about not being afraid to speak up. It's sitting in the front. When we go for some of these, I've been not been in the role for long, so it's only been 7 months, but I had the opportunity to attend our Sovereign Wealth Fund forum, which is global. And not being afraid to sit in the front. I went and sat in front because that's where the more
CEOs
established, it's for all CEOs, but that's where the assumption is the more established funds will sit, but that's also an opportunity then to get to meet them one-on-one and introduce yourself. Got to present on Rwanda, and we were pitching to host the conference. So I think it's so much. I don't focus on sticking out as a sore thumb in the room. I think it's more the focus on, okay, now that you're in the room, how do you actually take advantage of being in the room, regardless of what people might think when they see you? Yeah.
How surprised were you when the white paper came out and your name was there as the next CEO of the Agaciro Development Fund? And then you get into the office. Can you take us through, your first couple of weeks as CEO? How did you have to move in this very new institution, new space? What was that experience like? Because I'm thinking you had previously come from the Kigali Innovation City, right? So I think it must have been quite different, those experiences.
I'm not new. I was at least I wasn't new to government. So, and usually I think there's a handover process and onboarding with your predecessor, with your board, and so there's a lot of with your ministry, your line ministry, which is the Ministry of Finance. So that helps ease the transition, and I think you have. There's a lot to dive into immediately, which you get into. So I think it was more the volume of what the focus was on how do I understand the portfolio, what are the issues. It's not like time stops for you to adjust, and so you have to hit the ground running from day one. But it was a. And I don't think you're still hitting the ground running and learning, but in general, I think there was infrastructure to support in terms of people, in terms of the board, in terms of the ministry and people you could rely on, and then the team that you find, and then I think the rest is actually just doing the work to make sure that you're up to speed and asking for help and asking questions for what you don't know, because you can't assume that you know everything from day one, and just being open that you always just be learning. And I think even today I would say I'm still learning, but at least you've eventually get a good grasp of the portfolio. You understand the mandate, and then everything else is it's you go with the flow and just keep
And the announcement, did you see it coming?
I don't know if you you ever see it coming. Yeah.
So let's talk about the fund. But before we go into the fund itself, maybe you can help us define certain terms, because not everyone understands financial speak, if I may. So first of all, what's a sovereign wealth fund, which is what Agaciro is, right? Secondly, what's it supposed to do? And the third question is it normal for countries such as ours, and in this case I'm meaning poorer countries that are not as rich in resources, is it normal for countries like ours to have sovereign wealth funds?
Okay. So the simple way to think about a sovereign wealth fund is like a savings account for the government, right? So I hope you have a savings account for yourself.
Yes.
But money that you put aside, you're investing for a future date, right? The simplest way to think about a sovereign wealth fund is like a savings account. The same way you ideally have a savings account.
Yes, that's ideal.
And it's money that you put aside for future
rainy day
investments, rainy day, and to build a house, maybe for investments and so on. And so in this case, it's a nation's savings account for future investments for that rainy day. The objective, especially for Agaciro, I think is around financial autonomy for Rwanda, and so that is both by delivering financial return on the investment that you have. But it's also by making the right kind of investment. So making investments, primarily domestically, because there's a development mandate that you have as well to grow the economy, but also being, for instance, a partner with other local or foreign investors. So in general, I think there's now a category it's like a sovereign development wealth fund, which sort of captures that idea of you're saving for rainy days and for future generations, but at the same time you're also investing primarily in the domestic market so that you can grow it. In terms of whether Rwanda is, how many sovereign wealth funds are there, and the history. The history has always been that these were funds that were started with countries that had, oil reserves or budget surpluses. So I think the first one was Kuwait when they discovered oil in the 50s and they put it aside. Over time, more countries, even countries that are not necessarily resource rich, have started. In Africa, I think we now have about 7 that are considered full sovereign wealth funds, and then 3 that are new and are associate members. So it's definitely unique for a country like Rwanda.
What countries in Africa?
Morocco has one, Botswana for their reserves, Nigeria, Libya,
Mauritius?
Gabon. So Mauritius is new. So they've also set up one. Ethiopia, who else? But there are around 10 that are estimated. I think those are about 7, and including ourselves. So there's been increasingly more countries setting up sovereign wealth funds. I think what's unique about our case is that this was done in 2012. So many years ago, when I think there was less. There were less sovereign wealth funds that, except maybe from the Asian countries, where they had Asian countries similar to us, where you're not. It's not a commodity-based sovereign wealth fund. So like Singapore and China.
So are like the ones from, say, Botswana, obviously it's because of diamonds. Nigeria, probably because of oil. Ethiopia, that I guess it's.
Ethiopia is very similar, where it's state-owned companies and like a holding company.
It's similar to the Agaciro Fund?
Similar, to some extent, because they have a lot of the state-owned companies form part of the portfolio.
In terms of GDP, right? So when we look at Rwanda, our GDP is about close to 15 billion a year, dollars a year, slightly less than that. Is it, when I look at those other countries that you gave us as examples, these are countries with a far higher GDP than ours. Because, when you, again, like you named those countries, they're either mineral rich or they're industrial giants like Morocco and even Ethiopia. What about Rwanda and the size of our economy? And it was even smaller then, right? That the 15 billion is today and now. 12 years ago, it might have been maybe what, 8? What about us gave us that idea of starting something that maybe shouldn't have been in our financial bracket? Does that make sense, what I'm trying to say?
It does. My view is, if you look at how we've always managed the economy, I think for the last 30 years, there's been this principle, I think even championed by the president, around self-reliance and autonomy, right? In many ways, and dignity, which I think is where Agaciro got it, the name comes from as well, right? And it's sort of been infused in everything that we do, even before the fund. So even if you think about how we manage aid, it's really, can you partner with us on our vision, not on your terms, right? So I think sovereign wealth funds are part of your arsenal, if you like, of tools that you can have as an economy, as people who are stewards of the economy. It's like the Ministry of Finance, in terms of, this is how we grow our economy. Yes, some people can see it as a luxury, but I think it's the same way you would want, even personally, you would say that regardless of how rich you are, you should have a savings account, right? I think it's more about the discipline to set it up, the vision as to what it will do, and then the commitment to fund it, which is something else that the government also did. And then you start small and you just grow with that. So I do think that it's not that the fund itself is what makes, like having a sovereign wealth fund is what makes it unique. I think it's more about why you choose to do it and how you do it, and when you do it, that is unique about the Rwandan story, because we did it when, yes, you didn't have, it's not that you necessarily had a surplus of budget or you had export revenues. No, we still were in a deficit, but you said it doesn't matter, we're going to put money aside, right, every year, because at some point in the future we want to be to have more autonomy on our financials. We want to be able to make investments. We've always said we want to reduce reliance on aid. I think then it also took sacrifice. So if it's not coming from surpluses of your budget or exports, where's that money going to come from? So there was one, contributions from citizens who also, had a similar value of we want to have agency in how the country runs. There was matching funds from government. So there was at least an initial 55 billion that has come through contributions over time from citizens, from private sector, from governments, from Friends of Rwanda diaspora. Then there was now the government putting in its companies, its equity holdings in, BK Group. This is revenue that you could be getting every year to go into the national budget.
If I may, before we go into the details, things happen because of a reason. What happened in 2012 and around that time that made the Agaciro Fund necessary?
So I think there was a lot happening in 2012, especially geopolitically, but also in terms of, I think that was a time when we also started to see aid cuts from some of the development partners.
Yeah, if I can. I remember at that time I was working in the New Times, and
so you can tell us what.
Yeah, I can. I'm old enough to have been there. So M23, which is still an issue in Eastern DRC, that was the very first time it appeared as a force going up against the Congolese state. So around that time, there was still that narrative that M23 is actually a Rwandan-backed rebel movement. And when M23 started advancing towards Goma, there was a lot of noise, Rwanda. And our different partners started cutting aid. I remember the Dutch cut aid, the Swedes cut aid, the Americans cut aid. And there was a lot of questions about, oh my God, how will we survive as a people? Because from 1994 up to that time, it was known that, we were the aid darling. We're still called the aid darling, but it was even larger than. There was no Visit Rwanda. There wasn't. We were not the growth engine that we are now. And that was I think at the time, they thought that cutting our aid, it would bring us to our knees. Financially, as a government, as a people. And I remember that the conversation was, will that be allowed to happen? Is this who we are? Do we live and die by the whims of foreigners? Do we not have more value as a people? Hence the Agaciro Fund. And I remember there was that push. It actually did not start from government. If I remember, it was the public sector, the private sector. It was different political parties saying, let's do something. Let's buffer ourselves against these shocks that come. And so I remember that time, and I kind of wonder. I just wanted to ask you, before we go into the numbers, because that's something I want to ask, is when you have access to the books now, are we in much better standing in terms of the Agaciro Fund and what it's supposed to be, which was, as you said, something that will help us survive external shocks? Are we in a better place than we were 12 years ago?
So when 12 years ago, if you look at, there was a movement of we need to do something. And you're right, came from the people, right? But what you could also have, that money could also have just gone into, your current spending account to deal with today's issues.
Yes.
So I think what, unique about what was done was the ability to step aside and say, okay, we're getting this money. We could choose to spend it now as a way to reduce the effect of less aid, or we need a structure of how we will continue to collect it, but also grow it for the future. And I think and that's where the vision, discipline, and so on is very important, right? Because if you had chosen to spend that money today, like, government budget is significantly still much bigger than the fund. The fund is at just over 300 billion assets under management. When you look at government...
Francs or dollars?
Francs, 300 billion. Government spending budget this year alone was 5 trillion, right? So we still have a long way to go, because I think ultimately where you want to grow your savings account is to, if one portion of your budget cannot be met, this is where you would turn to it, right? So I think we still have a long way to go in terms of growing the fund to be that rainy day fund. But we're a long way. We were at 20 billion then. We're now at 300. That's just over 300.
You just said 50 billion. I thought we started with 50.
No, in 2012, we started at 20.
Okay.
Then over time, 55 was the total contribution, because it wasn't just in 1 year, it was done over time. And now we're at 300 billion in terms of the total portfolio. So we've grown by 15 times since that initial funding. But had the government chosen that, we're going to spend this now versus save this for later, I think we'd be talking a very different story about whether we'd have a sovereign wealth fund today. Yeah. So I definitely think what's unique is that we actually having the discipline then to say, I will not touch this, and I will create a vehicle where we can invest this, where we can grow it, and where over time this is what we can rely on. And at a time, like we said, other funds start at a time of plenty. We came at a time of
literally.
We said that you started saving at a time when you didn't
have a surplus.
You didn't have a surplus, and in fact, you were having a reduction in budget. And I think that's part of what is unique about our leadership, and then also about the founding of the fund.
Would you like to partner with us here at the Longform? If you do, you can send an email to us at longformrwanda@gmail.com. Partner with us and become part of Rwanda's most exciting and in-depth podcast. So you've told me today we are at 300 billion francs in assets, I guess, that's what you say, assets under management.
Yeah.
So when they say assets under management, is it like money in the bank? What are those assets?
So it's a mix. So you look at it as a portfolio, right? So you'll say we have an asset allocation. Around 60 to 70% is in equities.
What does that mean?
So equities is both listed shares in, let's say, on the companies that are in the stock exchange, like Bank of Kigali, but it's also shares in companies that are not listed, private companies like Irembo. So that is like 60% of our portfolio, 60 to 70%. Then the balance is what we call the fixed income portfolio, and then some of it is also then very liquid assets. So fixed income is treasury bonds, T-bills, corporate bonds. We also have some on the cash, what we call cash and cash equivalents, which is more your very liquid portfolio. So if you needed money today, you're able to draw it down. We have some term deposits. Those are now sitting at the bank earning interest. You have your current account. So it's really a mix. And I think because ultimately a sovereign wealth fund, you're an asset manager. All those are your different assets. And so you want to diversify so that across them, so that you can manage your returns, but also your risk.
I'd like to ask about the criteria. So you've kind of broken down 60% here, 30% here, a little bit of cash.
Like a range.
It is a range of cash. So what are the criteria for those different things, those different percentages? So when you say local, you have shares in certain local companies. What are those companies? And why do you choose those companies?
So maybe our current portfolio, I think earlier I was also explaining about how the fund was capitalized. So beyond the contributions that citizens, government, and private sector made, there was now additional, I want to say, infusions of capital from government. So one was their equity shares in state-owned companies. And then the other was they assigned proceeds, like revenue proceeds. So every time there's a privatization, every time auctions, concession fees, that money was revenue they would forego to go into the budget and would go to the fund to grow the fund. So most of our equity portfolio today, we have now 28 companies. Over time, we've sold some 26 of those were companies that were previously from the Ministry of Finance portfolio that then were transferred into the fund. It's not all the government-owned companies, but it's a significant number of that. Most of the companies that were transferred were the most mature. So BK Group, which we have a significant financial services, BRD, INM. We have a tech portfolio, so Irembo, KTRN, who does the fiber optics, AOS, broadband systems. We also have agriculture companies in tea, coffee, rice, and then logistics and manufacturing. So it's about 26 out of 28. We've since done an additional investment. One was in TDB Bank, which is a regional bank. That was done last year. And so I think with the portfolio that we inherited, that was, most of them were, growth sectors. As a good amount of them were already very well performing financially, even issuing dividends. Some were much younger, and so only now you were starting to see some of the returns. So that was sort of that was the criteria that was used in terms of maturity and so on. Today, when we're looking at equity investments, you're looking at what's the return, what's the financial return over what period of time, what's the level of risk you're taking, what is, you also look at qualitative factors, like do you have a partner who in this business? So we recently launched a fertilizer blending plant, and that's in partnership with OCP Africa.
Is it the one in Nyamata?
In Bugesera. And they've been doing this. This is their bread and butter. It's a multinational. So, you have a strong operator who has technical expertise, because you're a financial operator. You don't necessarily have the technical, operating skills for each industry. So also looking at that, looking at management. So those are we really want to invest on commercial terms. Also then looking at, okay, what's the impact of this investment? Because if you want to grow the fund, you need to make money.
So you don't think, because sometimes you can either go into making money or maybe some kind of impact, right? So a Rwandan might ask you, why don't you invest in things that will create jobs? Maybe not as profitable, but maybe will create more jobs. Or someone else will say, no, I'm Rwandan, I don't just make money as much as possible. Which one is, when you guys are coming up with the criteria of, okay, we're going to spend this little money that we have, which one is a bit more important? The impact or
I think first
or
you
the money
have to
made?
have a financial return, because if you don't have a financial return, what you're doing is you're taking away from the fund, right? You're depleting the fund, which is not what you want to do. So I think first is you have to have a financial return, but then the impact is also important. I think the beauty about the country today, I would say all our companies are impactful. In agriculture, you're organizing value chains. We're co-invested with cooperatives. In fact, even in rice, we even sold some of the shares to one of the rice cooperatives.
Really? Where?
Chirehe Rice Company. So we sold a percentage of the shares to the cooperatives, which is giving them wealth in the company, but it also because they're the ones supplying the rice, right? So now they also have a chance to own part of the company. So I think there's different impact. There's different ways to have impact, not just number of jobs, because sometimes number of jobs is not the only metric. Some industries are not necessarily job intensive, but they still have quite a big impact. So where I would say across the board within the portfolio, you'll see that you have the financial return, but there's also the impact that it's having, especially given where our economy is and the needs that we have. Because we're in sectors that are usually you're the first mover. Look at companies like Irembo; they're transforming how public service is done, right? So I do think that it has not had to be a trade-off so far. But I think at the same time, you need to make sure there's a financial return. Otherwise, what you're doing is depleting the fund, and then you're not really an investor. I think that's unless the grant capital available. There's other forms of capital that we have in country to be able to do that are not necessary. That don't necessarily have to come from just this. This is one of many vehicles that government has to create impact. But I think with this one specifically, there also has to be a financial return.
And when you think about financial returns, how much time do you give yourselves to say, you know what, we need money out of this? Because you can say, okay, I'm trying to make short-term returns, 5, 6, 10 years, versus maybe something that might work in 20 years. Like when you're looking to invest in terms of time, what are you looking at?
In equities, it honestly depends because different industries have different time horizons. If you look at, let's say, financial services today, which is arguably one of the most mature industries that we have, right? Those are areas where you know that today I invest today. If you go invest in even MTN on the stock exchange, I invest today, I know that there's a dividend every year. They have a history of paying dividends, right? So I think that it really depends on the industry, it depends on what you're doing. And so we have the ability to be more longer term in nature. So if you're, let's say, a pure private equity firm, you're looking at, I need to get out in 5 to 7 years. We don't necessarily need to get out in 5 to 7 years, but we would like to see growth in companies. You'd want to maybe list some of these companies over time. You want to get some of that money out and take it out. So it really depends on the industry. But so far, I would say we consider ourselves long-term, and then depending on the industry and the opportunity to get out, then you get out. And sometimes you also you're minority shareholders. So if the majority shareholder sells, you probably have tag along, you're also able to sell. So it's not a fixed amount, but I do think we look at it in terms of, okay, what can I get over time? And this has to make sense in the long term for the money that I'm putting in.
Have you, because when we think about this country, some of the key drivers of our economy is tourism, aviation. Have you put any money in any tourism, in Rwanda Air, in Visit Rwanda?
No, those are not part of our portfolio. Those are part of the overall government with the Ministry of Finance.
Why not?
I think for certain strategic, if you look at the size of the fund, if you start with that, we're still quite small. So you wouldn't, and when you look at some of the larger infrastructure projects, I think they require a lot more capital, a lot more patience, a lot more. So I would say over time, we can start to look at larger infrastructure projects, but 300 billion, a portion of that is already in companies that are operating. You also have to have your fixed income. We're not, I think gradually you can start to do bigger investments, but it's usually a function of size, and the government's balance sheet is still strong enough and large enough to be able to invest some of those.
And
maturity of some of the, you weigh the maturity of some of the industries, how early do you come in?
Yeah. And do you only invest in country?
No. So we have, so for example, TDB Bank is a regional bank. Yes, they cover East Africa, but they don't.
What I mean is, are you in the London Stock Exchange? Are you in the New York Stock Exchange? Places like that?
Not yet. I think eventually you would want to also have more geographic diversification over time, but not yet. Yeah, we're still very much a primarily local investor with a few investments here and there that are not primarily domestic.
And is that on purpose?
It is. I think one is we're sovereign development fund. And then I think two is, and we still have a lot of needs in country, but I think over time, as you diversify, you also start to look at, you diversify in terms of equity, types of assets you invest in, or you diversify in terms of currency, and then you also look at geographically where else can we be investing. So it's more of a journey, and getting on that journey as you grow the fund. But for now, what the principle usually with funds is that you start to invest primarily outside your market when you've almost also exhausted, or you coming in is overheating the economy, like you're crowding out people. Yeah. And right now there's also still a lot of need in country. Yeah.
So today we are at 300 billion francs. So that's what, maybe $200 million, slightly over. Which is, if you look at where we started from, 50 billion, we've grown quite well. So let me play a scenario for you. So if we are to grow at pretty much the speeds that we've been growing over the last decade or so, what does the fund look like in, say, 2034, 10 years from now? And I just kind of give us a sense like, okay, we are here. When I put money in a bank, because you said that it's our savings account. When I put money in a savings account in, say, BK, I might get about 9, maybe 10% if I have enough money and I can negotiate a great rate. So if I put 100 francs today, I'm having that and, compound interest for the next 10 years. So today we are about 300. You're investing in all sorts of things. What does it look like for us? One, what's our, per year, for example, what are we growing at an average? And then we see, what are we kind of looking at? Like, are we going to hit maybe $800 million in 10 years? Are we hitting $1 billion in assets under management?
It's a good question. You're asking us to have a crystal ball,
Yes.
And you can have a crystal ball if you can. If you can predict what your returns will be, right? Because you have an equity portfolio which is really dependent on many macro and different factors that can change how your equity returns. Your fixed income is a bit easier because that's usually, let's say, the government rate plus maybe a margin. So what I would say is that I think the best way to say this, because no one ever wants to put a target because you don't know what the future will hold, but I think the best way to say this is that if we were to, let's say, grow at 10%, we would double the fund in 7 years. And 10% is
it a high rate? Because some of us,
I think it's a very conservative rate, right?
So is 10%. Is that normal growth rates if you're not, if you don't have a disastrous decade?
Like a base case, yes.
Okay.
Yeah, with no high inflation periods that, for instance, we've seen in the past few years with assumptions on steadiness, then you can double that in about, and you do 10%, you double that about 7 years. Obviously, you want to grow higher than that, especially you want to, because there's also, for instance, you want to grow higher than inflation, right? Because you want to preserve the actual purchasing power of the fund, right?
Yeah.
So there's you want to go over the borrowing rate as well. So there's different ways that then when you go asset by asset, you try and say what should be the benchmarks across this. But in general, if we at least, to say a worst case scenario, which was 10%, you would be able to grow the fund you would be able to double the fund in 7 years.
would you be happy with that if you are still CEO of Agaciro Development Fund 10 years from now? Would you be happy with that number, that you've doubled the fund in 7 years?
Oh, of course not. We're an ambitious country.
So
I think what's now the priorities for us are, first of all, to say within the portfolio that we already have, for instance, the companies that we own, how much more, how can you support them to grow faster, right? Some of them are much younger, so it's a factor of time. Others, it's when they need more capital, what are they investing in, and so on. So I think there's one is like, how much value can we get out of our existing companies, and that's and supporting them to get that. I think so. That's one area where we really can create a lot of value. How we invest also on the fixed income side, like looking at if we get to a point where we have also more financial products. So part of the challenge we have is we need more products on our capital markets as well for institutional investors. And we're starting to see that. You're starting to see more corporate bonds, for instance. We've had 2 corporate bonds in the at least announced in the last year, which was BRD and another energy company. You now have unit trust. So I think as also our markets develop and we have more products, and we are both on one hand a supply of these products, because if our companies raise funding through the markets or list, you're supporting the markets, but at the same time we're also people who invest in these products. So as the economy evolves, there'll be more also products that you can invest in, which have also higher returns. So corporate bonds, for instance, will always have a premium over government bonds. So then you're able to get a bit more return than what you would where if you're primarily invested in government bonds. Or if we have more listings, you have a bit more diversity. So I think we have an opportunity to get to grow more. But in this business, you also you don't know what shocks will happen.
True.
So I think that, and then the other part is that there's also the other sources of funds, which like the privatizations and so on. So that money coming in, you can't necessarily predict it all the time, but as it comes in and you reinvest it, there's always opportunities to grow the fund beyond that. And as our companies do better, because remember with our companies, you're seeing increased dividends from some of them, like BK, you're seeing increased returns and so on. So all that plays into your overall return and performance. And I think we have an opportunity if, at the current pace that we're seeing in terms of growth, the ambitions, the more diversification of products to invest in, doing investments like TDB, which are more established, also give you a different type of return. That will allow us to really grow the fund, to actually accelerate the growth of the fund.
And how do you hedge against? Because you've said that you can grow, but then there might be external shocks. Yes. But then some of those external shocks can also be hedged against. I think one of the biggest shock that we are thinking about is probably climate change or our geopolitical realities. So as the fund, what are you doing to hedge against those realities? We know that there's going to be some major changes in the next 10, 15 years. What are you doing to hedge?
So it's a good question. So diversification is one. So in our industry, diversification is important. So if you look at, which is also a natural hedge. So take COVID as an example, right? In COVID, we saw transportation suffer, but you saw technology, like more transactions on companies like Irembogo. So the diversification of industry gives you that hedge as well for different shocks. So different industries will be shocked at different times, or one industry being shocked actually is an opportunity for another, like in that case. Then also to some extent currency and geography. So TDB, for instance, is a dollar investment. So you're
What's TDB?
It's a regional TDB, regional bank.
It's called TDB.
It's TDB Group, and it's a regional. It has a bank. It has.
Is it the one that used to be called the PTA?
Former PTA Bank.
Okay.
So that's an investment that is in dollars. So your appreciation is in dollars. Your dividends is in dollars. So you're also at least hedging from a currency side, right? Then you have between equity and fixed income, because the thing about your fixed income portfolio, which is your treasury bonds, which is your corporate bonds, is that usually there's always when it's tied to there's inflation is sort of baked in and so on. So rates will also go up when some of those shocks happen. So I think there's that natural hedge that you tend to see with diversifying your portfolio. There's now new challenges and opportunities. Climate change. Should you still be growing X crop in this area based off rain? And some of what we're doing in that is, for example, like with aspects like with fertilizer and so on, it's like you're now bringing customized fertilizer into the industry. You're understanding what does my geography need, and that's an investment that we're making, right? So I think it will have impact in at least helping the agriculture sector understand, like, okay, I need to be able to this is how I increase my yield because of what is the health of my soil or weather patterns and blah, blah, blah. So I think there's some of it comes through the portfolio. We need to increasingly use technology. I think there's now, even with the space agency and others, there's a lot of work being done to really understand what is the impact of climate change, looking at past data, predicting future data. And I think using that to inform decision making is going to be, you will have to do it. And that's something that we will have to start doing. I think, so you have, you just have to keep, these are things you monitor every day. It's part of the, it's just part of what asset management is. It's not just looking at returns, you're looking at risks, and you're trying to quantify those risks and understand what is the impact of this on a portfolio. You even have company-specific risks, like in technology, there's increasing costs for software engineers. How do you manage that? Because that's affecting your profitability. So there's always multiple risks that you're constantly having to manage. And I think that's part of the beauty of the job, is how do you use that for decision making? And then now thinking about what are the kind of tools that can help you do that.
So last question. For every savings account, there's a time when you dip into it, right? So it's all good and it's all well and dandy, growing and growing and growing this until kingdom come. But the whole point of it is that we will have, hopefully in the future, a stock of money to, touch when we need it. We, last couple of years, went through COVID. It was a time when it was really, really rough. But even then, we didn't touch the fund. This might be a question that maybe you cannot answer, but what will be the thing that makes us have to liquidate the fund and actually get the money?
I don't think we should ever liquidate the fund.
Oh, okay.
Because you always need, for as long as the country is operating, you need a savings fund. And in fact, if you look at sovereign wealth funds today, for some of them, the much older ones, they're still operating, even when shocks happen. Now,
which one's the older one? Which is the oldest
Kuwait, one? I think is the one that's like most recognized as the oldest. So I don't think you ever liquidate the fund. I think what happens is there comes a time when the size of the fund can potentially contribute to a shock. So in the same way.
What does that mean?
So for example, let's say in COVID, some funds at that time, some of the sovereign wealth funds had gone to a point where they could say, okay, we're going to draw 10% to fill this hole that we have in the budget, right? And I think and that's because the budget of the country versus the sovereign wealth fund were now almost at par, or even the sovereign wealth fund is bigger in terms of assets. So I think you're trying to go to a point where it will you can eventually fill some holes that you might have if there are shocks, or even for new investments that you might have. But I think that tipping point happens when you have a fund that's big enough to also, that one withdrawal for a shock won't deplete it. I think that's the way that you would almost look at it. So even universities who have endowments, they'll say, look, I have 100 million endowment, I contribute maybe 15% to the university operations, the rest I keep investing, right? But it's not because that's the only thing the university is depending on. There's tuition money, there's XYZ. So I don't think this is a let me liquidate and deplete. I think it's more that at what point can you start to also, pull money from the fund for needs that the government has. I think that's a treasury and economic management discussion, but typically that point comes when you have a sizable fund that pulling money out, it continues to operate. Yeah.
Tesi, thank you so much for your time. I really enjoyed this discussion.
Thank you.
Did you enjoy it?
Yes.
If you enjoyed the conversation today, share your thoughts with us on our social media platforms. You can find us on Twitter, Instagram, and TikTok.